If you receive Social Security SSI or SSDI through direct deposit, an important change could be costing you money every single month. Banks across the country are rolling out new account fees that are quietly reducing benefit payments for millions of recipients. These changes are hitting fixed income households the hardest, and many people don't realize it until the charges appear on their statements. Today, we're breaking down what's happening, who's affected, and how to protect every dollar of your benefits before more money's lost. Financial institutions across the United States are implementing structural changes to entry level checking accounts that have long served as the primary deposit destination for Social Security, SSI, and SSDI benefits. These changes are largely driven by cost recovery strategies, declining branch usage, and shifting regulatory and operational expenses. As a result, many banks are replacing traditional no fee checking products with tiered account models that include mandatory monthly maintenance charges, service fees, or balance related conditions. For benefit recipients who depend on direct deposit as their sole source of income, these charges effectively reduce the net value of each monthly payment. Individuals living on fixed incomes are particularly vulnerable to these adjustments because their budgets are typically structured around predictable, limited cash flow. Monthly benefit payments are often allocated immediately toward housing, utilities, medical expenses, insurance premiums, and food. When recurring banking fees are introduced, even in relatively modest amounts, they can disrupt carefully balanced spending plans. Over time, these fees may force beneficiaries to make difficult trade-offs between essential needs, increasing financial strain and reducing overall economic stability. A growing concern is the manner in which account changes are being implemented. In many cases, account holders are automatically migrated into paid account tiers without actively opting in or fully understanding the new terms. Notifications, when provided, are frequently embedded within lengthy disclosures, mailed inserts, or digital communications that may be overlooked or misunderstood. This lack of clear, prominent communication can result in beneficiaries discovering new charges only after fees have already been assessed. Minimum balance requirements and fee waiver conditions are becoming more restrictive. Benefit recipients who regularly draw down their balances to cover monthly expenses may find it difficult or impossible to maintain required thresholds, triggering repeated penalties. Over time, these cumulative fees can materially erode account balances and diminish financial resilience. From a systemic perspective, these practices highlight a growing misalignment between mainstream banking products and the needs of fixed income populations. While financial institutions continue to modernize their service offerings, the reduction of accessible, low-cost account options creates barriers for seniors, disabled individuals, and other benefit-dependent households. Addressing this issue requires greater transparency, consumer awareness, and broader access to banking alternatives that prioritize affordability and financial inclusion. Minimum balance requirements are increasingly being incorporated into standard checking and savings account structures, creating significant challenges for individuals who depend on Social Security, SSI, or SSDI as their primary source of income. For many beneficiaries, monthly deposits are designed to cover essential living expenses with little to no surplus remaining. When financial institutions impose balance thresholds, often ranging from a few hundred to several $1,000s, account holders are placed in a position where maintaining compliance is unrealistic. Falling below these thresholds frequently triggers maintenance fees, compounding financial strain, and reducing the effective value of benefit payments over time. Alongside balance requirements, paper statement fees and other administrative charges are becoming more prevalent. These fees are often introduced as part of broader cost reduction or digital transition strategies within banks. However, they are not always communicated clearly or prominently. In many cases, charges appear on account statements with minimal explanation, leaving customers uncertain about their origin or purpose. For seniors and individuals with disabilities who may rely on paper statements for record keeping, accessibility, or oversight by caregivers, these fees can feel unavoidable and confusing. The cumulative impact of small recurring charges can significantly affect annual household budgets. Financial institutions are scaling back account benefits that were historically offered to seniors and fixed income customers. Fee waivers tied to age, disability status, or benefit deposits are being eliminated or replaced with more restrictive eligibility criteria. Similarly, preferential interest rates on checking or savings balances, once marketed as loyalty or senior benefits, are being reduced or discontinued altogether. While the monetary value of these incentives may appear modest, their removal signals a shift away from accommodating vulnerable populations within mainstream banking frameworks. From a technical standpoint, these changes reflect evolving profitability models within the banking sector, prioritizing account consolidation and standardized pricing over individualized customer needs. For benefit recipients, the result is a banking environment that requires greater vigilance, frequent account monitoring, and proactive decision making. Understanding fee structures, statement disclosures, and eligibility conditions is now essential to minimizing financial leakage and preserving limited monthly income. Banks across the country are steadily reducing or eliminating no fee checking and savings accounts that were once widely available to Social Security, SSI, and SSDI recipients. These accounts historically provided a basic, low cost banking option designed to accommodate predictable, fixed monthly deposits and modest balances. As institutions transition toward tiered pricing models, no fee products are being replaced with accounts that include monthly service charges, usage based fees, or conditional waivers tied to balances or transaction activity. This shift has narrowed access to affordable banking for benefit dependent customers and increased the cost of maintaining even the most basic accounts. As account structures become more restrictive, overdraft and low balance penalties are being triggered with greater frequency. Many benefit recipients schedule payments, withdrawals, and automatic debits around a single monthly deposit. When minimum balance thresholds are raised or transaction timing is less flexible, accounts are more likely to dip below required levels. Even a brief imbalance, such as a utility payment posting before a deposit clears, can result in overdraft fees or low balance penalties. These charges are often assessed automatically, leaving little opportunity for customers to intervene. From a technical perspective, banks increasingly rely on automated fee assessment systems that apply penalties in real time. These systems do not account for income type, deposit frequency, or vulnerability associated with fixed income reliance. As a result, benefit recipients face a higher probability of fee accumulation compared to customers with variable or higher incomes. Repeated overdraft charges can also place accounts at risk of closure, further limiting access to traditional banking services. The removal of no fee options also reduces consumer flexibility. Without access to basic, low cost accounts, beneficiaries may feel compelled to maintain accounts that do not align with their financial realities. Over time, recurring penalties can erode monthly income and undermine financial stability. These developments underscore the growing disconnect between standardized banking practices and the needs of individuals who rely on government benefits for essential living expenses. Beneficiaries who maintain low account balances are increasingly exposed to gradual account erosion as cumulative service fees reduce their available funds over time. For individuals relying on Social Security, SSI, or SSDI, account balances are often intentionally kept low because monthly deposits are immediately allocated toward essential expenses. In this environment, even modest recurring charges, such as monthly maintenance fees, low balance penalties, or service related assessments, can steadily diminish the value of benefit payments. While a single fee may appear insignificant, the compounding effect across multiple months can result in a meaningful loss of income for households already operating with limited financial flexibility. From a technical standpoint, these fees are typically assessed automatically and deducted directly from account balances, often without active customer interaction. Because benefit recipients may not regularly review online statements or transaction histories, fee accumulation can go unnoticed until balances fall unexpectedly low. This creates a cycle in which fees reduce available funds, increasing the likelihood of additional penalties tied to minimum balance requirements or transaction limits. Over time, this process can undermine account stability and reduce a beneficiary's ability to manage cash flow effectively. Compounding this issue is the growing requirement for digital enrollment to avoid certain fees. Many financial institutions now condition fee waivers on actions such as enrolling in online banking, receiving electronic statements, or managing accounts through mobile applications. While these requirements are intended to reduce operational costs, They can disadvantage older adults and individuals with disabilities who may face barriers to digital access or technological literacy. Limited internet availability, accessibility challenges, or discomfort with digital platforms can prevent full participation in these systems. Beneficiaries who are unable or unwilling to enroll digitally may be subject to higher costs simply for maintaining an account. This structural shift places added responsibility on vulnerable populations to adapt to technological expectations that may not align with their capabilities. The combination of low balances, automated fee structures, and digital prerequisites highlights a growing inequity within modern banking practices, underscoring the need for more inclusive account options that account for the realities of fixed income and aging populations. Credit unions and alternative financial programs continue to provide lower cost banking options that are often better aligned with the needs of individuals receiving Social Security, SSI, and SSDI benefits. Unlike large commercial banks, credit unions operate as member owned institutions, which allows them to prioritize service affordability over profit maximization. Many still offer basic checking accounts with no monthly maintenance fees, minimal balance requirements, and reduced penalty structures. In addition, alternative financial programs designed specifically for benefit recipients frequently eliminate credit checks and offer transparent fee schedules, making them more accessible to individuals living on fixed incomes. Despite these advantages, awareness of these options remains limited among beneficiaries. A major contributing factor to this lack of awareness is the long-standing reliance on direct deposit arrangements established years or even decades ago. Once beneficiaries link their benefit payments to a bank account, the system encourages long-term account stability with minimal interaction. This set and forget structure has historically worked well, but as account terms evolve, it can obscure changing fee structures and account conditions. Many beneficiaries continue using the same accounts out of habit or concern about disrupting their benefit payments, even when those accounts no longer meet their financial needs. From a technical perspective, direct deposit systems are designed to ensure consistency and reduce administrative complexity, both for beneficiaries and government agencies. However, this efficiency has also increased dependency on traditional banking relationships. When banks modify account pricing or requirements, beneficiaries may feel constrained by the perceived difficulty of changing deposit destinations. This can lead to prolonged exposure to unfavorable account terms, including recurring fees and restrictive conditions. The combination of limited awareness and perceived switching risk creates a structural disadvantage for fixed income households. Beneficiaries may not actively compare alternatives or reassess account suitability, allowing costs to accumulate over time. Improving education around credit unions and alternative financial programs, along with clearer guidance on safely updating direct deposit information, is essential to empowering beneficiaries to choose financial services that better support long-term stability and income preservation. Monthly banking costs for individuals receiving Social Security, SSI, or SSDI benefits can accumulate quickly, reaching hundreds of dollars annually when considering maintenance fees, low balance penalties, overdraft charges, and paper statement fees. For fixed income households, this represents a significant erosion of limited resources, directly affecting the ability to cover essential living expenses such as rent, utilities, medications, and food. Even seemingly minor charges, when applied consistently over a year, can create a measurable impact on financial stability, reducing both short-term flexibility and long-term resilience. A major contributing factor to this financial burden is the lack of transparency in fee disclosures. Many banks provide information about new charges through dense account agreements, fine print notices, or electronic communications that are easy to overlook. Without clear, accessible explanations of when and how fees are assessed, account holders may remain unaware of accumulating costs until they appear on monthly statements. This opacity complicates budgeting and makes it difficult for beneficiaries to anticipate or prevent avoidable charges, particularly for those who are less familiar with modern banking technology or complex account structures. From a technical standpoint, fee structures are often automated and dynamic, adjusting based on balance fluctuations, transaction frequency, and account type. These automated systems are designed to maximize institutional efficiency, but they can disproportionately impact individuals whose account activity is limited or who maintain low balances. For benefit recipients, This creates a persistent risk of unintentional fee accumulation, further eroding the value of monthly deposits. To mitigate these risks, proactive account management is essential. Regular review of statements, understanding the terms and conditions of accounts, and exploring alternative financial institutions, such as credit unions or programs like Direct Express, can help preserve the full value of government benefit payments. In addition, maintaining awareness of digital tools, setting up account alerts, and opting out of unnecessary services can prevent unexpected charges and enhance financial security. In an environment where banking costs are rising and transparency is limited, informed, deliberate decisions are critical to safeguarding both monthly income and long-term financial stability. If you receive Social Security, SSI, or SSDI benefits, staying informed about new banking fees is crucial to protecting your income. Small charges can quickly add up, but with proactive account management and awareness of low-cost alternatives, you can safeguard every dollar of your benefits. Take control of your finances, review your accounts regularly, and explore options that prioritize your needs over bank profits. Protecting your money starts with knowledge and action. Don't let unnecessary fees chip away at your hard-earned benefits.